Hello, everyone, and welcome to the ODFC Academy Podcast. Today, we are diving deep into a massive market shock that literally just sent shockwaves through India's crypto ecosystem. But we're not just looking at the problem. We are going to unpack practical, actionable guidance on exactly how you can protect your portfolio. Let's jump right in. 8.5%. Take a moment to really let that number sink in. That is the incredible sudden surge we recently witnessed in India's USDT stablecoin premium. This is absolutely not just a tiny blip on your trading chart. It is a massive, ringing alarm bell for all of us. It shows exactly what happens when market design crashes headfirst into regulatory enforcement. So what caused this? Well, this dramatic shock completely interrupted a major supply channel in the market. And the immediate reality for traders? Absolutely brutal. Entry costs were pushed so much higher in a flash, and everyday market liquidity simply evaporated into thin air. It is a perfect textbook example of a market choke point failing under immense pressure. Now, you might be wondering what exactly was the trigger here. It all traces directly back to the recent Enforcement Directorate raids, specifically focused on firms in Bengaluru. These firms were reportedly involved in unauthorized cross-border stablecoin transfers. And the very second authorities stepped in, boom, the broader market instantly felt the structural consequences. It perfectly aligns with what our own ODFC Academy crypto market observer recently noted. They pointed out that these enforcement actions, while completely necessary from a regulatory standpoint, really expose the severe fragilities in our market's plumbing. Think about it like a major pipeline. When a key supply route is suddenly shut down, it creates this massive wedge between onshore demand and the tiny amount of available USDT left. That wedge is exactly what creates that huge premium. The absolutely crucial thing we need to understand here is the core problem hiding right beneath the surface. We call this concentration risk. This is the incredibly dangerous habit of over-depending on a very limited number of counterparties or leaning way too heavily on informal rails for your liquidity. Relying on just a few dominant sources is like putting all your eggs in one very fragile basket. When one goes down, your entire trading operation goes down with it. And the relationship here is so direct and honestly pretty unforgiving. Compliance gaps literally equal evaporating liquidity. If you have operational and legal blind spots in your trading strategy, you drastically increase the odds that a sudden enforcement action will completely wipe out your ability to trade. It is a risk that absolutely no serious market participant can afford to ignore anymore. Which brings us to an absolutely vital question for this edition of the ODFC Academy Podcast. What immediate, concrete actions can lower your risk during periods of intense regulatory uncertainty? It is time we pivot away from just staring at the problem and start exploring highly actionable institutional-grade solutions you can literally implement today. The very first critical response for any trader facing this kind of shock is to intentionally tighten your position sizing and significantly reduce your leverage. By purposefully cutting down that leverage, you dramatically lower your tail exposure during these highly volatile, wildly unpredictable market events. It's all about surviving the storm. Next up, you absolutely must aggressively widen your counterparty sourcing. You need to actively engage with multiple, rigorously vetted liquidity providers. Do not just rely on a single dominant source. If one provider unfortunately gets swept up in a regulatory freeze, you need to ensure your other channels remain completely open and fully operational. To build a truly resilient strategy, we at the Academy strongly recommend monitoring a specific blend of on-chain metrics to create dynamic hedging rules. Instead of just reacting to scary news headlines, you need a framework that responds to actual flow changes. You do this by meticulously tracking stablecoin flows, analyzing the signals coming from over-the-counter volume, keeping a very close eye on decentralized exchange liquidity depth, and carefully measuring your custodian concentration. But let's zoom out for a second. What about the massive institutional players? How do huge exchanges and high-volume market makers survive a sudden shock like this? Well, to maintain true stability across the broader market, these institutions desperately require incredibly robust operational playbooks. We're talking about strategies that go way, way beyond basic trading and just hoping for the best. For the big players, it really all comes down to absolute contingency readiness. You must have multiple settlement rails firmly in place long before disaster actually strikes. Maintaining those backup rails is an absolute necessity. It is also completely crucial to enforce strict contractual clauses that require comprehensive compliance certification from all your major counterparties. That is how you make sure they don't bring contagion directly to your front door. Furthermore, you have to establish your emergency communication protocols beforehand. When you are right in the middle of a crisis, there is simply no time to figure out what you are going to say. You need to be ready to issue transparent notices to clients, smoothly implement temporary spread adjustments, and create prioritized liquidity windows. These steps are absolutely essential for maintaining total market confidence. And we definitely cannot ignore the heavy shadow of retrospective tax exposures, along with the frankly terrifying prospect of sudden account freezes. You see, tax and compliance uncertainty drastically raises the effective costs of literally any cross-border transaction. You have to carefully weigh potential reporting burdens because a counterparty's hidden non-compliance could unexpectedly freeze your hard-earned funds at any moment. When we talk about pure survival, the contrast in strategies is incredibly stark. If you are leaning into aggressive cross-border arbitrage, you are leaving yourself entirely exposed to sudden enforcement sweeps. Instead, the smart move is shifting entirely to local hedging positions. By utilizing local hedging, you can completely minimize cross-border settlement risk, at least until those unpredictable flows finally begin to normalize. So, taking a step back and looking at the big picture, we really have to ask a very hard question. Why do systemic failures like this just keep happening? Why does our industry find itself repeating these exact same structural cycles of panic and frozen funds over and over again? Well, it points to some massive underlying educational and structural gaps spread across our entire ecosystem. The absolute fatal flaw in the ecosystem right now is our reliance on completely siloed market professionals. Think about how true this is. The most brilliant technical engineers often lack basic legal literacy. The most diligent compliance officers completely ignore crucial on-chain signals. And the absolute sharpest traders frequently lack the rigorous operational playbooks they need when the market plumbing inevitably breaks. This exact, very frustrating problem is what the ODFC Academy solution tackles head-on. We use a truly blended educational curriculum. By intentionally merging deep legal understanding, complex finance, and rigorous technical training, our primary goal is to permanently break down these incredibly dangerous silos. It is all about empowering professionals to actually communicate across domains so we can build truly resilient systems together. At the foundational layer of the program, we dive incredibly deeply into tokenomics and blockchain mechanics. We take the time to explore exactly why a sudden supply shock in the hidden plumbing of the market immediately, and often violently, translates into a massive price shock for everyone anxiously watching the charts. Then, as we move up to the operational layer, everything revolves entirely around intense scenario-based simulations. We run live, incredibly realistic drills to stress test your spreads, analyze sudden massive spikes in funding costs, and mathematically model exactly what happens to critical margin requirements when a major liquidity channel suddenly vanishes into thin air. And at the very top is the compliance layer, which we deliver through highly tailored bespoke workshops. These institutional programs are designed specifically to cover advanced know-your-customer rules, rigorous anti-money laundering protocols, and the architecture of incredibly robust cross-border transfer frameworks. Ultimately, this significantly reduces your exposure to enforcement actions. But we have to look beyond just the individual firm level, because constructive policy dialogue is absolutely necessary for the entire industry to thrive. Regulators really need evidence-based technical briefings to understand exactly how narrow enforcement actions can cascade into market-wide crises. At the exact same time, the industry must step up and present transparent controls to safely prevent illicit flows without totally destroying legitimate settlement channels. If you are a smaller fintech company or an exchange looking to partner with massive banks or custodians, establishing mutual due diligence and shared technical standards right from the very start is paramount. These are absolutely non-negotiable steps. You need them to align your compliance procedures, standardize your agreements, and completely prevent those devastating single-point failures in your custody arrangements. As we wrap up this episode of the ODFC Academy Podcast,